With economic uncertainty looming, rising interest rates, inflation cooling but still high, and global tensions, how do you protect your portfolio? In this video, we'll cover what makes a stock recession-proof, reveal 5 top picks for 2025, and share strategies to weather any economic storm. This is a deep dive, so grab a coffee, hit that like button, and let's get started. First, let's define what makes a stock recession-proof. These are companies that thrive, or at least hold steady, when the economy tanks. Here are the key traits we're looking for. Stable demand. These companies sell products or services people need, no matter what. Think groceries, utilities, or healthcare, not luxury goods. Strong balance sheets. Low debt and plenty of cash mean they can weather tough times without layoffs or dividend cuts. Consistent dividends. Dividend-paying stocks provide income even when stock prices dip, acting like a safety net. Defensive sectors. Sectors like consumer staples, healthcare, and utilities tend to outperform during recessions because they're less tied to economic cycles. In 2025, with fears of a slowdown driven by high borrowing costs and geopolitical risks, these traits are non-negotiable. Now, let's explore why recessions hit markets hard and how these stocks can protect you. Recessions are rough. Consumer spending drops, businesses cut back, and stock markets can plummet. During the 2008 financial crisis, the S&P 500 fell nearly 50%. In 2020's COVID crash, it dropped 34% in weeks. But here's the good news. Defensive stocks often lose less or even gain value. For example, in 2008, consumer staple stocks fell just 15% while the broader market tanked. Why? Because people still buy toothpaste, medicine, and electricity, even when times are tough. These companies have predictable revenue, which stabilizes their stock prices. Plus, many pay dividends, giving you cash flow to reinvest or cover expenses. In 2025, economists are mixed. The Fed's high rates could slow growth, but a soft landing is still possible. Either way, owning recession-proof stocks reduces your risk. Let's move to our top 5 picks for U.S. investors in 2025. First up, Walmart, ticker Walmart. Walmart is the world's largest retailer, selling groceries, household goods, and more at low prices. During recessions, consumers trade down to discount stores like Walmart, boosting its sales. Why it's recession-proof? Groceries and essentials are non-negotiable. In 2008, Walmart's same-store sales grew 3.4% while competitors struggled. Its scale keeps costs low, and its e-commerce growth, up 22% year-over-year in 2024, makes it competitive. Financials. Walmart's debt-to-equity ratio is a manageable 0.6, and it has $8 billion in cash. Its dividend yield is 1.2%, paid consistently for over 50 years, with a 9% increase in 2024. The PE ratio is around 28, fair for its stability. 2025 outlook. With inflation still pinching wallets, Walmart's value proposition shines. Its investments in automation and delivery could boost margins, even if consumer spending slows. Risks. Competition from Amazon and rising labor costs. But Walmart's size and reliability make it a core holding for U.S. investors. Next, Johnson & Johnson, ticker Johnson & Johnson, a healthcare giant. J&J makes medicines, medical devices, and consumer products like Band-Aids. Healthcare is recession-resistant because people don't stop needing treatments or surgeries. Why it's recession-proof? J&J's diversified portfolio spans pharmaceuticals and medical devices. In 2020, its revenue dipped just 0.6% despite COVID disruptions. Its R&D pipeline ensures long-term growth. Financials. J&J's debt is low, with a debt-to-equity ratio of 0.4 and $20 billion in cash. Its 3.2% dividend yield is rock solid, raised for 62 years straight. The PE ratio is 14, undervalued for its quality. 2025 outlook. Aging populations drive healthcare demand. J&J's new drugs and devices position it for steady growth, even if the economy slows. Risks include patent expirations and legal issues, but J&J's track record makes it a safe bet for stability. Third, NextEra Energy, ticker NE, a leader in utilities and renewable energy. Utilities are classic defensive plays because electricity demand stays steady, recession or not. Why it's recession-proof. NextEra provides power to millions in Florida and runs the largest U.S. renewable energy portfolio, wind and solar. Regulated utilities guarantee stable cash flows. During 2008, utility stocks fell just 10% versus the market's 50%. Financials. NextEra's debt-to-equity is 1.1, typical for utilities, but its cash flow covers debt easily. The 2.8% dividend yield grows 10% annually. Its P/E is 22, reasonable for its growth. 2025 outlook. Clean energy demand is booming, and NextEra's solar projects position it for long-term gains. High interest rates could pressure utilities, but its growth offsets this. Risks, regulatory changes, or rising rates. Still, NextEra's blend of stability and growth is perfect for 2025. Fourth, Procter Gamble, ticker PG, the king of consumer staples. P&G makes everyday products like Tide, Pampers, and Gillette. These items stay in demand, even when budgets tighten. Why it's recession-proof. P&G's brands dominate shelves, giving it pricing power. In 2020, its organic sales grew 6% despite lockdowns. Its global reach and innovation keep it ahead. Financials. P&G's debt-to-equity is 0.7, with $7 billion in cash. Its 2.4% dividend yield has risen for 68 years. The P/E is 25, reflecting its premium quality. 2025 outlook. Inflation may push consumers to cheaper brands, but P&G's loyalty and efficiency protect it. New products in health and hygiene could drive growth. Risks include commodity costs and competition, but P&G's consistency makes it a must-own. Finally, Verizon, ticker VZ, a telecom giant. People don't cut their phone or internet service during recessions. Connectivity is essential. Why it's recession-proof. Verizon's wireless and broadband services have sticky customers. In 2008, telecom stocks held steady while others crashed. Its 5G rollout drives growth. Financials. Verizon's debt-to-equity is 1.8, high but manageable with steady cash flow. Its 6.5% dividend yield is among the highest in the S&P 500, paid reliably for decades. The P/E is 9, a bargain. 2025 outlook. Demand for 5G and remote work solutions keeps Verizon growing. High debt is a concern, but its cash flow covers dividends and investments. Risks, competition, and debt. But Verizon's high yield and stability make it a recession-proof anchor. Before we wrap up, a quick word on risks. No stock is bulletproof. High debt, regulatory changes, or unexpected disruptions can hurt even defensive companies. Always do your own research and consider your risk tolerance. A financial advisor can help tailor these ideas to your goals. In 2025, uncertainty is real, but preparation is power. Stocks like Walmart, Johnson & Johnson, NextEra, Procter Gamble, and Verizon offer stability and income to weather any storm. Stay disciplined, stay invested, and you'll come out stronger. What do you think? Are you buying these stocks? Or do you have other recession-proof picks? Drop your thoughts in the comments. I read every one.